Hi, this is Vijay Bimwani and I'm recording this video still from my residence, confined indoors because of the lockdown. I hope you're staying indoors and keeping yourself and your family safe as well. Now in this video, I want to talk to you about an issue that has come to my knowledge over the weekend, and I've done some dirt digging, and I want to present a few facts which I'm sure you would have read in the public domain, and some of you might be a tad worried about what's happening to your investments in the fixed income space. I am a big fan of fixed income space. I think rich traders, and I've recorded a video on this in the past, rich traders allocate a fair bit of money in their investable portfolio to fixed income securities so that should things go a little topsy-turvy in the trading revenue side, you do not really get impacted in your lifestyle. Your home and hearth still runs on the yields and returns from the fixed income side. Now, what I read about over the weekend was that the debt fund managers in India were dumping AT1 bonds. These are tier 1 bonds of banks which constitute their capital. The bonds were dumped so aggressively that the yields on these bonds have jumped. You see, when the price of the bond falls, the return increases because the rate of interest is payable on the face value and not on the market price. So these bond yields have actually started jumping. What are tier 1 bonds? Do they concern you? Should you really be worried? And what is the way forward? Allow me over the next couple of minutes to explain myself. Banks require a certain portion of their loan book as their own net owned funds or their paid up capital. This is called the Capital Adequacy Ratio, CAR. As we stand now, the minimum that a bank should have its own capital is 8%. Of course, it can be higher. Actually, the higher the better, which makes the bank safer. Now, this 8% of its money need not all be in cash. It could be part cash and part tier 1 bonds, which it issues to investors to raise money which is constituted and taken as their capital. Now, these tier 1 bonds yield interest. The interest is higher than the sovereign guaranteed bonds because these are not sovereign guaranteed bonds, and therefore there is there's a certain element of risk. What is the element of risk in these tier 1 bonds? Should the bank suffer a liquidity issue, it can ask for a moratorium or a freeze on payments of monies, both interest and principal, to the bondholder. This was experienced recently in the Yes Bank case when the bank went under a moratorium period. Now, under normal circumstances, no fund manager would have imagined or dreamt in their wildest dreams that there will come a time when banks in India would sense a threat perception about repayment capabilities. But the Franklin Templeton issue, which basically froze 6 of its debt fund schemes, has given nightmares to the debt fund managers. Now, they do not want to hold anything which can be remotely associated with risk in their investment portfolio. The question that you will ask is, why did they invest in these tier 1 bonds in the first place? The answer is alpha. Alpha is absolute profits. You see, if all debt fund managers were to invest in sovereign guaranteed bonds, everybody's yield would be exactly the same as the next guy. There would be no difference in one debt fund scheme's NAV from the other. You would not have a choice as to see which fund manager was outperforming the other guys. Now, how do they go about achieving a higher NAV? They basically invest in a whole lot of diverse debt instruments, including corporate bonds, which are, remember, not sovereign guaranteed. They also invest in other debt instruments, in deposits of corporates. They also lend money in private financing deals to corporates, obviously, where the interest rate is far higher than the sovereign bond yield returns. And this is the way the fund manager takes that little bit of an extra risk to earn that extra return for you. Now, all is well as long as the principal and the interest that you're supposed to receive is safe. The problem starts when there's a threat perception. And Franklin Templeton's six schemes being shuttered for now has raised the hackles of many an investor and a fund manager alike. So they are dumping all these tier 1 bonds, which are basically of banks, which can ask for a moratorium on repayment should push come to shove. Why would banks do that? Now, anybody who's seen my TV shows and read my interviews and articles in the public domain over the last couple of years, especially a decade, would know that I've always been warning you about banks for the simple reason that the net interest margins are 3%. Your profit margin for running a bank is 3%. And in some cases of banks which are under prompt corrective action by the RBI, the NPAs have crossed 20%. You got me right. They have crossed 20%. So when you're earning 3% and you're losing 20%, now that's a big gaping hole in your balance sheet. Which is why there is consolidation, mergers and acquisitions between these banks. You've recently seen 10 public sector banks being merged and 3 entities created. SBI has merged its subsidiary banks with itself in 2017. This is all a function of trying to strengthen the balance sheet after the NPAs have eaten into their strengths. Now that these fund managers are dumping the tier 1 bonds, the yields have spiked. Should that rattle your basically psyche? Should it worry you? Should you sleep less in the night? Hey, I don't think so. All I have ever recommended are sovereign guaranteed bonds which are guaranteed by the government of India. I have deliberately recommended these bonds to you knowing that the yield would be somewhat lower, but your capital and your interest will be guaranteed by the government of India. Is there 100% certainty that this money will always remain safe? There is no such thing as 100% certainty. At the end of it all good things in life, including life itself, must someday come to an end. But I would bet my money, and I've bet a good deal of my money in sovereign guaranteed bonds of myself, my corporate entity, and my family. I'm not worried. I think 99.99% my money is safe in sovereign guaranteed bonds. Why am I saying 99.99%? Because 100% is not something that I can live with. Although I would like to believe that sovereign guaranteed bonds are 100% safe. So, if you have gone by my videos and invested in sovereign guaranteed bonds, sleep easy. You have nothing to lose, not for now. And what if, over a period of time, the interest rates are cut on these sovereign guaranteed bonds? Remember, the interest rates can be cut on future issues. If you're holding a 2018 series, if you're holding a 2020 series, which were issued at the interest rate back then, those interest rates would still be available to you. It is the new issues that will have a lower rate of interest. But in that case, the price of the existing bonds would go up because the market would bid the price higher. So existing bondholders would get a capital appreciation on the bond prices going up, and they would still have locked in that interest rate which was negotiated at the time of purchasing the bonds. Sleep easy, all is well, and stay with quality paper. Do not succumb to the temptation of earning higher yields in order to basically keep your lifestyle going. I have warned you in the beginning of this calendar year that 2020 is a challenging year for fixed income investors. Your yields are going to fall. You've got to learn to live with that, but do not sacrifice your capital in order to earn a higher return on capital. Your return off capital, which is your principal, must never be compromised. Stay safe. Look after your health and your families. Look after your investments and trade. With that, I bid adieu to you. Not before reminding you to like this video if you're watching this on YouTube. In the comment section, do let me know what you think about this video and what you would want me to record in my next video for you. Do not forget to share this video with your family and friends and help me spread the cult of knowledge-based investments. Also, join Equity Master and myself on Telegram on Equity Master's Telegram channel with the handle Equity Master Official, wherein I post at least 2 to 3 updates every day, Monday to Friday. I would love you to read them. Vijay Bambwani signing off for now. Thank you very much. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.